So to begin, what I'd like to explain, and this is what I also explained during our live presentation, is that the world is quite aware that we need to follow a specific carbon budget in order to avoid exceeding 1.5 or 2 degrees of global warming. These carbon budgets are often presented in graphs that look like this, and I just want to point out that despite the fact that we know we need to radically reduce our emissions, um, it's pretty clear that these forecasts or um, projections require us to suddenly change the direction of our emissions trends. So we would need some quite powerful and structural change to the world economy that would turn the ship around very quickly in the short term. And it's always been the case that the world has not um, found a policy toolkit that can do that. There is no indication at all that the world is suddenly going to change its growth trajectory in terms of dependence on fossil fuels in the short term. Of course, we've got COVID-19, and that's reduced our emissions, but when the economy recovers from COVID-19, energy consumption will increase again and emissions will increase somewhat. Another problem of the carbon budget is that even if we turn the ship around and start to reduce our emissions in the medium term, those emissions reductions have to be very fast. Like we're talking 3 to 8% per annum compound reductions to stay under 1.5 to 2 degrees of global warming. And as it stands, there doesn't appear to be a policy toolkit that's powerful enough to provide the finance and incentives for that rate of change. Thirdly, there is another problem, and that is the carbon budget for the future will always involve, well, is predicted to involve significant residual carbon emissions. And what this means is that the world is very, very likely to exceed the 2-degree carbon budget by about 1,000 gigatons of carbon dioxide this century. And that implies we will need carbon dioxide removal technologies to balance the global carbon budget to net zero. So this is really an unavoidable challenge. And climate scientists are concerned about negative emissions technologies because many of them are not proven at scale. So that's a short summary of the global challenge. I think that many people are aware of these problems. But the question then is, what is the theory for change or economic theory of change? Because we know that we have an objective, and nation states, governments are starting to, or many of them are making statements that they're going to commit to net zero emissions by mid-century, including China agreeing to net zero by 2060, the European Union, the new administration coming into the United States, the Biden administration may very well make such a commitment. But even when a large proportion of the world economy has committed to net zero, how do you implement that objective? How do you make that objective actually manifest as reality? Well, this is where we seem to be missing a critically important policy that can provide the required finance at the speed and scale and also be highly targeted for the objective. So the Global Carbon Reward Initiative really began around 2013 or 14 when I began studying the idea of using a new currency system to finance climate mitigation. So I've been working on the discovery phase for about 5 or 6 years with some publications, and I believe that we now have a pretty good theory of change for how to transition the world economy to a low carbon future, or at least provide the required level of finance. This project is moving into phase 2 in 2021, and so we have some ambitious plans to find an international NGO as a fiscal partner, so that we can then raise sponsorship, raise money, and find governmental partners and private partners to set up demonstration projects. So I'll talk about that more towards the end of this presentation, but basically this is the 3-phase approach for the Global Carbon Reward Initiative. The theory of change revolves around a new biophysical analysis of carbon pricing. In summary, that analysis, or the results of the analysis, is presented here as the carbon pricing matrix. And so the carbon pricing matrix, what it is, in effect, is a classification of different market-based policies in a 2x2 matrix based on the store of value, which is either sticks or carrots, and the unit of account, which is either fiat money or carbon-based units. This two-dimensional matrix has major implications for our understanding of carbon pricing and the economics of climate change, but it does not appear in textbooks, and it's not currently a topic that's discussed in the economics of climate change because it's so new. But the important thing about this matrix is that it reveals that we may have, or the economists may have, overlooked a fundamentally important policy, which is called the Global Carbon Reward. And what's important about this policy is that it directly links climate finance to central banks. The reason being is that the analysis indicates that this policy should use a new currency, a carrot with carbon units. The other 3 policies in the matrix, they are somewhat standard policies: subsidies, carbon taxes, cap and trade, also called emissions trading schemes, ETS. These cap and trade or ETS schemes, they also tie into carbon markets that are trading carbon offset credits. Those policies fall into a basket called fiscal policies, and they are run and operated by government. So they are not really of the same scope as a monetary policy, because a monetary policy that links to central banks has the ability to find new finance that is not going to appear on the balance sheet of the government, either as taxes or revenue. Another important understanding of these policies is that the Global Carbon Reward, when it's funded by central banks, it also influences financial markets. And it's important to understand how the price signal will influence financial markets. These other traditional policies, they also influence financial markets, but in different ways. Now, one of the findings of my analysis is that the Global Carbon Reward may very well resolve some major economic conundrums related to systemic risk. That's quite a long conversation, so I'm not going to try and explain it here. Here is the carbon pricing matrix again, and here we're going to focus just on the Global Carbon Reward. By way of introduction, the reward is defined or is introduced as a new currency. Now, one of the challenges here is to point out that the economics textbooks and the narrative on climate change economics does not include the concept of a reward. It's a new concept. And the Currency itself has some unusual properties. It has a unit of account that is a mass of carbon dioxide equivalent mitigated for the long term. So this is a biophysical unit of account. And what that implies is that this money, new money, will be a type of representative money. An example of representative money is like a gold-backed dollar. This is a new currency backed by ecosystem services. The second point is that the currency is a financial asset because its exchange rate will be managed by central banks. So that's a very important point. It's not a floating exchange rate like national currencies are in the post-Bretton Woods era. The currency is not legal tender, it's not a carbon offset credit, and it's not a cryptocurrency. These are key points because if we were to start a conversation about a currency, a new token that's to reward climate mitigation services, most people would first assume that it's going to be a currency that we use to buy things, like go to the shop and buy bread and milk with it. You couldn't do that with this currency. It's really just a store of value and a financial asset. It's not a carbon offset credit. That's very important. If it were a carbon offset credit, that means that polluters could buy the currency and use it to claim that they're achieving net zero in their enterprise. But that's not going to happen with this currency. It's not legally allowing anybody to take ownership of the carbon that's mitigated. That carbon is owned by an institution that issues the currency, and they retire that carbon automatically. So by analogy, this is much more similar to voluntary purchases of carbon offsets because voluntary purchases are not used to offset emissions somewhere else. It's not a cryptocurrency, meaning that this is not another Bitcoin. This currency would be managed by a public institution through public-private partnerships, and it could be traded in cryptocurrency markets, but there is no need for that. The purpose of the currency is to fund climate mitigation without creating direct costs for stakeholders. So this approach will create new finance, transfer wealth and purchasing power without creating any direct costs on citizens, businesses, or governments. This kind of approach actually has a name. It's called off-balance sheet. So it's an off-balance sheet approach to finance. In terms of the scale of finance, there is a need to mobilize somewhere between $3 and $6 trillion per year to decarbonize all sectors of the world economy by mid-century. Now, these figures are rubbery. I don't claim to say that these are actually correct figures, but the 1 to 3 trillion has been quoted by energy institutions that do research on the costs of energy transition. And then you might add on 1 to 3 trillion for the fact that it's not going to be easy. And then we need more money for carbon dioxide removal, and that the administrative costs of full decarbonisation will be quite expensive. And this money will also help to support the Sustainable Development Goals as co-benefits. The global carbon reward rules themselves, they are all defined, managed, and justified through a risk management approach. And what that means is that the price that is going to be achieved with this policy, the reward price, will be justified based on a risk management approach. And there are international standards on risk management. You know, there's theory and math and everything, and that's the kind of approach that will be used. The global carbon reward as a concept, it's very novel, but it's not in isolation from other narratives and stories that are evolving in the world. And in particular, in central banking, there are 3 new megatrends that are emerging in the early part of this century. One is that central bank financial regulators and the economists, etc., they are discussing and debating how central banks should be involved or not in providing finance for climate mitigation. And this is a very complex topic because it really revolves around the mandates of central banks. Traditionally, central banks do not partake in market-specific finance. They like to use a very broad brush approach and to be market neutral. And so to break through that mandate philosophy, we would need a strong argument. And the argument put forward here is that the theory indicates that we would need a risk management approach based on the carbon pricing matrix. That's a discussion probably for academics and philosophers, but nonetheless, that is an important discussion. The second megatrend is that most of the world's central banks now are doing research on central bank digital currencies, which is effectively digital cash. And digital cash from central banks is not the same as the cash that you and I use digitally through our commercial banks. There are two different types of money in the economy: the reserve currencies that are owned and operated directly by central banks, and then there's private money created by commercial banks. And so if the world gradually shifts into a cashless society, possibly with central bank digital currencies, that is a new mega trend with major implications for public policy. Quantitative easing is another mega trend. As you would know, the Federal Reserve, the European Central Bank, and other central banks created a lot of new money, trillions of dollars, and used it to purchase financial assets like government bonds, corporate bonds, and I'm not sure what else they've been buying, but they purchased a lot of assets to try and stimulate economic growth, part of the recovery from the global financial crisis in 2008-9, and now the COVID-19 recession. These three megatrends are relevant to the policy because the policy actually makes use of these megatrends and effectively combines them together. So here I'm just going to explain in the simplest possible terms how the currency is created. Okay, so if we can explain the supply of the currency, that's a really good start. So the way it works is that there will be projects around the world of different types, and three main types are cleaner energy, carbon dioxide removal, and reductions of emissions from enterprises. Now, when a project is seeking finance under this policy, they need to actually have a viable project and be actually mitigated. Then they can apply to a public institution, which will be the same institution for everybody, I presume, and they will be asked to sign a service agreement, which contains the rules for their rewards that matches their technology and the sector of the economy they're in. They'll be assigned a mitigation assessor who will then estimate the amount of carbon they're mitigated under the rules and calculate their reward, and then they can receive the digital currency. So that's the process. It's really quite straightforward. It's not that much different to the way carbon offsets are issued. However, in this case, the rules will be tailored for the objective of the policy, and the problem of additionality doesn't really exist as it does with carbon offsets because we're not offsetting. Additionality really just becomes another variable. The other side of the coin, so to speak, is the demand for the currency. So if we can explain demand and we can explain supply, then we've explained how a price will emerge in this new market. So in this policy, the assumption is that central banks will be operating under a internationally coordinated monetary policy where they will agree to purchase the digital currency, which is denoted as this orange coin. Okay, just for the sake of communication. That's what it looks like. And the green banknotes represent national currency. It could be US dollars or euros, etc. So what will happen is that the project owner, who's this person here, may have earned some currency. They were the owner of, say, a clean energy project. Then if at the point in time that they want to cash that in for national fiat currency, they can do that by selling it into the marketplace, because they might need to access that money to pay down debt or to purchase things or just to realize the profit. So they can sell it to private investors who will want to buy it for the reason that this particular currency will have a rising value over time. When the private investors want to sell it, they can always sell it to a commercial bank, because the commercial bank is in a position of being the intermediary for this currency. The reason is that they're the obvious institution to on-sell it to the central bank. So they can sell it back to the central bank at a margin, knowing that the exchange rate is on a rising trend. And that's how the digital currency will flow from project owners through financial markets into commercial banks and then back to the central bank, who will then hold it in reserve indefinitely. And they will create new money, they'll expand the money supply, and that will feed back to the marketplace. So this is a stimulus package, in effect, debt-free. Okay. Now, I'll talk more about the debt-free nature of the financial stimulus, but that's effectively the currency demand. So, as I said, if there's demand and supply, there will be a price or an exchange rate. And as part of this policy, the exchange rate will intentionally be managed to rise over time. Okay. The exchange rate won't be arbitrary. It's going to be calculated or assessed based on how much more mitigation we need globally. So this will be linked back to what's called an abatement cost curve, or a levelized cost of abatement, or whatever you want to call it. Hard currencies and all currencies in the world are mostly unmanaged. Some are managed, but generally they fluctuate. So here's an example where you can see the euro fluctuating in value, and we don't know, we can't predict what the value is going to be in the future necessarily. So it's not investment grade currency. It's just another hard currency. But our new currency, which is a representative currency, will be an investment grade currency. So it will act more like a sovereign bond than it would a normal currency. Some key points are that we can use this mechanism as a macroeconomic control over global decarbonisation, because, the price signal can be used macroeconomically, and then we've got all the reward rules which can be massaged and refined and adjusted microeconomically. So we get a macroeconomic control on total quanta of decarbonisation through the exchange rate, and then we've got all the microeconomic rules to adjust each little sector of the world economy in each geographic location. So this is a big project. Just a point that theoretically we're actually pricing climate risk. So the justification of the policy, as I said, is risk-based. It's not fundamentally founded on the notion of improving market efficiency. Market efficiency falls under Pigouvian economics, and that's the justification for the carbon tax and similar policies. This has a different justification. So another point that I wanted to make very quickly is that the monetary approach introduces a new way for nation states to equitably share the costs of climate mitigation, because the costs through this policy will be channeled into monetary inflation, and that inflation can or should be managed to be uniformly constant across all economies. And in this way, the costs won't actually appear in any fiscal budgets. And generally speaking, I don't think people will even notice necessarily. It also integrates well with financial technology because there are whole new platforms and systems being developed around digital currencies, like with blockchains, the hyperledger system, and et cetera, et cetera. Good governance to people and planet. Um, what I wanted to talk about here is the idea that ecological breakdown, species extinction, etc., is a major crisis in itself. This ecological crisis we're facing globally is really both separate to the climate crisis and coupled to the climate crisis, because we as a civilization are over consuming natural resources, and that in itself is of a planetary level. But when we add to that climate change, it's just going to make things so much more unsustainable. For example, half of the corals in the Great Barrier Reef have have probably died now because of coral bleaching. Uh, Warm water corals globally will not survive 2 degrees of global warming, or not even 1.5, probably. So we will lose major ecosystems at a planetary level, and this does not uh, look good for humanity. We don't know what the implications are going to be, and so we have to do something at a global scale to repair and restore ecosystems the best we can. This middle article here is discussing a recent report that found that 1 million species of plants and animals are at risk of extinction. And it also includes other statistics which are really frightening, including percentages of wildlife that have been lost and so on and so forth. It makes grim reading, but we need to get a handle on this and to understand that we're facing a dual crisis of climate change and ecosystem breakdown, and that ecosystems co-evolve with the climate. So if we're going to restore the climate, we should do, or sorry, if we're going to protect the climate, we should do it in a way that maximally protects and restores ecosystems at the same time, because the fact that carbon sequestration is possible to some degree using biological methods. So the governance model itself is decentralized, and the concept here is that we can use weighting factors to adjust the rewards higher or lower to reflect the social and ecological co-benefits that come out of these climate mitigation actions. So the concept is quite simple at first. The concept is that social co-benefits can be prioritized by public voting. So we collect people's opinions on what they want in terms of social co-benefits. These opinions and preferences can be collected through the internet and then associated with communities and societies according to their political geographic location. And that information is then used to calculate the weighting factors. And a similar process can happen for ecological co-benefits, but we would rely more on expert voting, not just public voting when it comes to ecology. So the decentralized governance model simply says we weight rewards higher when there are more co-benefits, and we weight them lower when there are harms. And the statistical weighting process will ensure that it doesn't distort the carbon budget, because the issuance of currency will always be proportional to the total carbon stocktake under this policy. So I'm going to just quickly explain social weighting with a hypothetical example. The details are not to be taken too seriously, but it's just an illustration. So in this illustration, we might assume that there is a community living somewhere, it could be in Latin America, and this community may need more energy, and they might be opening up their economy to renewable energy projects, and hypothetically we'll assume it's a wind utility. So in this hypothetical, the community have voted on their social priorities, which are listed here. Number one being local employment, number two, respecting their local customs, number three, improving the local economy, and number four, providing affordable energy. So hypothetically, let's assume that the wind utility got this report card where they scored poorly on all of the first three items, but they did provide affordable energy. So this could happen in reality because it's quite common for utilities to employ people from the city and not to create jobs locally. And then the revenues from the energy could go back to the city, which would be a kind of a tax on the local economy. So in this hypothetical, the calculated weighting factor is 0.75, which means that the utility can earn the reward, but it would only earn 75% of what it would purely based on carbon mitigation. The 25% then can be reallocated to other projects that produce more social benefits. Here's another example, but this time an ecological weighting. And in this example, we'll just assume there's a catchment somewhere that is the target of a reforestation project. Experts have voted on the ecological priorities for this catchment, and they put forward biodiversity protection, water quality, protecting endangered fish species, and sustainable harvesting as the main priorities. So in this hypothetical, the project scores high on all the key ecological priorities, and they get a weighting factor of 1.25, which means they earn an additional 25% rewards. And that 25% would come from other projects, either regionally or internationally, that weren't as beneficial or may have been ecologically harmful. So that's the concept. Now, in the last part of the presentation, I'd just like to quickly go over the opportunities for demonstration project. So in phase two of our Global Carbon Reward Initiative, we want to move quickly by finding an NGO partner, an international NGO, find sponsorship, and find a government or governments who are willing to support the demonstrations by tying in the Global Carbon Reward with their central bank under special dispensation to provide some finance, not a lot, just enough to run the demonstrations. And then we'll set up the administrative system and run the demonstrations. So I'll just talk about that now. The demonstration projects themselves, they have a very clear purpose. The purpose is to communicate how the financial mechanism works, communicate how the policy works. And I think this is the most important purpose of these demonstrations, because currently economists and policymakers and the general public do not really have a conceptual model that explains that it's even possible to provide scalable finance through monetary policy. Okay, this is debt-free finance, it's fully scalable and highly targeted. And if we can just show how it's done in documentary films, conferences, social media, etc., that can open up a whole new narrative in climate policy and economics. So to be a bit more specific, the point here is that we want to show how to create scalable rewards without forcing any direct costs on stakeholders. Then we want to show how an administrative system can be developed for issuing the reward and managing the currency, and show how the governance model can be developed and implemented maximising co-benefits of the reward. So this is really an exercise in storytelling as well as communicating technical concepts. I'm just going to quickly explain how the demonstrations would be set up as an organisation. These are really public-private partnerships. We would start with a international NGO that would be our fiscal sponsor, and the fiscal sponsor, or through them, we would find a government or governments that are willing to support the project. And I presume that there are countries around the world who are very keen to innovate in new central bank digital currencies and cryptocurrencies and climate finance. So I don't think that's an impossibility. They would need to bring in their central bank in some capacity, as I mentioned. It wouldn't be an official policy, so it doesn't require legislation per se. It just requires special dispensation to run the pilot project, and having enough access to finance to manage the value of this new currency for the pilot project. We then go out and find a few private companies that are doing good mitigation work who would want to be part of the demonstration. And so there are three key areas. One is carbon reductions, renewable energy, and carbon dioxide removal. And these projects, they don't have to be perfect. They don't have to be sequestering large amounts of carbon. They just need to show that they are sequestering or mitigating carbon and are willing to have their operations very carefully monitored, and that they be willing to be part of the storytelling, where they would be filmed and reported, and they'd be brought into conferences and in a global discussion. And really that's what it's about. There is not a high cost necessarily of being a demonstration project. It's really opening up their business to documentation, to collecting data, and then having assessments made. And it's even quite possible that they could earn some money out of this if the digital currency attains a significant value. And that's an option. The digital currency that we issue in the pilot could eventually go to the cryptocurrency market just to put it there, since it might not be used as the actual currency for the full policy if it's implemented. This platform that we would set up can be set up using existing technologies, using blockchains and other proprietary software, because central banks are already doing CBDC projects, and there's a lot of innovation in this space. So I don't think there'd be any problems finding the technologies and the service providers for this kind of pilot. So that's it in a nutshell. There is a lot more to this this climate policy in terms of theory. There's more work to be done in terms of quantitative assessments of the policy using integrated assessment models, etc. But that can all happen when the project gains momentum and financial support arrives for setting up a think tank. So thank you very much for listening to this presentation. I hope you found it both interesting and useful. If there's any other information you need, don't hesitate to contact me, and thank you for your time.